We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. U.S. stocks set to rebound from a brutal day of losses, and the S&P 500 is now in correction. Optimism that a government shutdown will be averted, helping lift sentiment on Wall Street. Check out shares of Peloton jumping on the heels of an upgrade. Canaccord Genuity upgrading the stock to buy and setting a $10 price target, saying Peloton will reap the benefits of being the, quote, clear leader in connected fitness. Chipotle also getting an upgrade and the stock is moving higher. Loop Capital coming off the sidelines, raising the stock to buy from hold. The analyst saying the chain has, quote, very manageable tariff risk and could implement some price increases to offset the tariffs. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks this session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. And we have special coverage for you today. Given the recent market volatility sparked by fears of a potential recession here in the U.S., we want to give you the resources, the tools, the tips, and the tricks that you need to navigate uncertainty. So on today's show, we will break down the definition of a recession and the indicators that you should watch to understand if the economy has entered one, and how to protect your investment portfolio at any age in the event of an economic downturn. Plus, how to turn uncertainty and a volatile market into an opportunity to build wealth. But first, we take a look at some of the market action 90 minutes into the trading day. Stocks are rebounding, attempting a comeback after Thursday's rout. The U.S. major indices all took losses later this week, sparking questions of whether the U.S. could be on its way towards a recession, a word that we heard from multiple guests at Yahoo Finance this week.
So my probability of a U.S. recession has gone up from 10% to 25 to 30%. So it's not the baseline, it's a fatter tail. The reason why it's not the baseline has to do with the structural strength of the U.S. economy. It also has to do with what we've been promised down the road in terms of deregulation, tax cuts, and the reality of low energy prices. So a bumpy journey with a growth scare, but recession is not my baseline.
Our base case is not a recession, but there is some softening in the data. I think one of the challenges that the market has had this year is that after a lot of economists have been focused on recession so much the prior 2 years, you came into 2023, 2024 with very low expectations for the economy.
Our base case, if you want to call it that, has been that we were on a glide path towards lower inflation. And as a result, lower interest rates over the course of time. Our base case continues to be one of a slightly slowing GDP, along with slowing global growth, and then also this glide path, if you will, towards slower means lower on inflation as well.
We're now basically have 8 recession calls since 2022, 3 so far this year, 5 in the previous 2 years. None of them have proven to be correct, and the reason for it is very, very simple. We are the largest, most leveraged nation in the world.
The National Bureau of Economics defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. For more on what makes a recession, I want to bring in Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder. Great to have you here in studio with us on this. It's been an interesting week for the markets, but more so because you have the R word entering into the fray once again. How do you define a recession?
Well, it's not arbitrary. It's not up for opinion. It's a pronounced, pervasive, persistent decline in output, employment, income, and sales. And so that becomes a self-reinforcing process, right? If let's say sales fall, production falls, employment falls, income falls, and then sales fall. And that's where you get a little tripped up into a recession.
And so what are those recession signals that you'll be looking for in the economy to the points that you were just mentioning a moment
Well, those are all coincident indicators. Like by the time you see them, the recession already started. Okay, so what you really want to be doing, what I would like to do, is to look forward and say, what's the risk of entering into a recession. And that you have to look at forward-looking leading economic indicators. I think confidence could be one, new orders another, credit is another. There's a whole slew, and they're all imperfect. So we put them into an index, have different leading indexes. That's literally all I've worked on my entire professional career. And it's complicated, but basically you could look at leading indicators, and when they start to move down, it tells you a window of vulnerability is opening up within which a negative shock, let's say, 1,000% tariffs, that's a shock. The market falls a ton, that could be a shock. You could have some big event otherwise, those are shocks. And the combination of window of vulnerability and a shock can get you a recession.
So what are the biggest misconceptions about recessions?
Okay. There's so many. There's so many. So just because the market goes down 10% doesn't mean there's a recession. Let's start with that, because that's what people are dealing with right now. That kind of happened last summer, but nobody remembers that. That was last July. It went down a lot. And basically during a slowdown, not a recession, just slower growth, the chances of a correction like we're having now, they just pop. That's just the nature of the beast. A recession would be a much more prolonged and deeper issue for share prices. That window of vulnerability doesn't seem to be open at the moment. Now that can change.
And so what's the outlook for the US right now from what the data is telling you? And do you see some of those red flags or warning signs of a recession at this juncture?
I wouldn't go that far. I would say warning signs of slowdown. Back in the end of 2024, it was kind of Goldilocks. We had a resilient economy and inflation had kind of settled down. It was pretty sticky and it was maybe even easing a bit further. Not too hot, not too cold, let's go, right? And you saw that. You saw those huge animal spirits. Now, the composition of how the economy is growing is changing. The services sector, where most of us work, is easing off a little bit. It had been hitting it out of the park for a couple of years. And so it's just decelerated a little. But most of us work there, we feel it. The manufacturing sector had been on its back for a couple of years. Now that's starting to actually get a little bit of a bid over the last quarter or so. And that composition is shifting. It all adds up to slower growth. During slower growth, you can have corrections. The headlines are certainly dramatic. I'm not taking away from any of that. If that makes its way into the leading indexes, then we have to talk about a window of vulnerability opening up. That's not the case today.
What do you think the driving point is, or the driving force that is leading so many to try and consider, or leading the markets to, which are forward-looking, to try and get ahead of what they're seeing that could indicate recession?
Yeah, so we're speculating here and trying to say what the market thinks is a tough game. But look, there's dramatic headlines and policy shifts. Those can eventually impact the direction of the economy, but the economy is like this huge supertanker. It doesn't turn on a dime. And it's been resilient, and the manufacturing sector has started already to turn up. That doesn't turn around because of a headline.
Right.
That's continuing to happen, actually outside of the United States as well. And there's even some signs that China is coming online a little bit. And so the global industrial base is starting to work a little more. And the US is well positioned to take advantage of that.
Lakshman, thanks so much for joining us in studio.
Right. Thank you so much.
Thursday's sell-off tipped the S&P 500 into its first correction since 2023. So what happens to stocks now? I'm Jared Blickery, host of Stocks in Translation, and let's answer this question right now. So first, a correction is a 10% drop from a 52-week high. Generally, it could be a record high on a closing basis, and that is what we hit yesterday. And some of the research that I've dug up really shows you different responses to these quick drops whether or not we are in a recession matters, and that's kind of what we're talking about today. Now, a quick caveat, we might not know we're in recession until well after it's over. That's because it's judged by the National Bureau of Economic Research. The rest of the world uses a pretty easy metric, 2 quarters of negative GDP, but we rely on a national body to do that. So here, there's a big difference between these volatility shocks that happen outside of recessions in white. Generally, there's a positive response, that is, markets snap back, versus green. And this only goes 100 days out, so it's not very long term. But I do think it's illustrative. Now, this is another analysis by Goldman, and what they did, they looked at the rate cutting cycle. So we have a Fed right now that has been cutting rates, and when they started, this is showing you what happens if it's followed by recession, and usually the market peaks well before the Fed started cutting rates, and then it heads down. This goes all the way to a year out, so that's a longer time. And then the opposite, if we don't have recession, well, guess what? The market hasn't peaked yet, and we tend to climb. The market just bounces back, and hopefully that's where we are right now. But again, we're not going to know that we're in a recession officially until probably it's over. So what do we know right now? We know we're in correction, and we know the speed. We know the time that it took us to drop into it. And in fact, that was only about 15 days. And if you put a longer window on that, and I'm going to show you that in a second here, up to 6 months, it drastically affects returns. When we have a quick drop from a record high like right now, the market tends to bounce back. This shows what happens a week later, 2 weeks later, a month, a quarter, and a year. And you can see a week later, tend to get returns, positive returns of 2.3% with a 90% hit rate. Then 2 weeks after that, it drops down, so there's a lot of volatility that tells you. On a 1 month basis, it goes a little bit higher. And then 1 quarter later, 100% of the time here, and I think this is with a sample size of about 9 or 10, we got median returns of 5.4%. And then a year out, 90% of the time, we are up for a median of 22%. Now, this is the quick drop from record high. I want to show you in contrast to the slower drop from record highs. And you can see the returns are a lot lower here, even a year out, only up 10%. And the positive percent returns are lower. So the good news is we got this quick drop from the high, and hopefully history plays out statistically, and we see a bounce back to record highs in no time. But we'll have to see if that is the case. So tune into Stocks and Translations for more jargon-busting deep dives. New episodes on Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
With recent market volatility pushing both the S&P 500 and the NASDAQ into correction territory, we want to discuss how to protect your portfolio at any age. Here to help break this down, we've got Douglas Bonaparte, who is the president of Bonafide Wealth. Douglas, great to have you here with us. Let's start with your overall view of the markets right now.
Sure, a lot of volatility, that's pretty obvious, but my number one thing to tell anyone is you have to stay the course, and if you don't have a financial plan in place, then go get that plan. You got to stick to your investment strategy over the long term and be consistent and disciplined.
So Douglas, what is your advice for young investors that are navigating this recent downturn?
Yeah, so fundamentals is everything to a young investor. We want to focus on cash flow. We want to make sure you have a cash reserve that allows you to stay in the game. The worst thing that could happen to a young investor is that they have to pull assets out of the market to meet a cash need. So by having a reserve, by making sure you understand how money comes in and out of your life, you can avoid needing to sell assets when they're low.
What about for parents out there, particularly thinking about some of those who are saving for their kids' college education, using certain accounts like 529s?
Yeah, absolutely. So it comes down to how much time you have on your hands. If you're talking about young children, like I got 2 young girls, we got plenty of time on our side. We actually can use this volatility or dips in the market as an opportunity, right? We have lower asset prices. So if you're averaging in or putting money into your 529 plans each month, here's an opportunity to get some of those lower prices. If you don't have as much time on your hands, this is where you really need to see, or maybe perhaps recalculate what it is you're going to need to put your child through college. So college education planning is a must here. And if you have to throw more money in it, assuming you can afford to do it, that might be an opportunity.
So there are some folks out there who are watching the market activity over the course of this week, and they are in retirement or near retirement, say within 5 years or so. And they're saying, all right, my time horizon is much less than those kids that are going to college. It's much less than the young professionals who are just getting started with some of their savings plans. And I might need to tap that money a little bit sooner here, or at least in a shorter time horizon. What about those people who are near retirement?
Obviously, the best thing to do would be before there's a correction in the market to make adjustments to your risk tolerance, bring up your positions in fixed income or less risky assets. But if you're in a position now where you're kind of reacting to it, again, is there more cash that you can set aside perhaps to save for that goal? I'll give you a great example. Here in 2025, retirees with their 401ks can actually, between the ages of 60 and 63, do additional catch-up contributions of $11,250. So there are opportunities to obviously supercharge savings if you're behind the eight ball and you didn't get a chance to adjust your allocation of your portfolios to become more conservative, right? You want to become more conservative as you become closer to the goal that you're trying to accomplish because you want to preserve that capital.
And so there's going to come a time where you need to tap that capital. And what is the advice for retirees who are actively drawing upon some of those funds that they've saved up over the course of the career and ultimately have perhaps a more balanced, less risky type of portfolio that they've been able to put together?
Absolutely. Cash is king here, right? For my retiree clients, up to 2 years worth of cash is going to be a really strong strategy, and it would allow someone not to have to tap risk on assets like their stocks over a 2-year period. And why I like 2 years is because your average recession typically lasts 2 years. So if you're getting caught up in a really down market or a recession, you have a lot of cash here to pay the bills. You also have less risky assets and bonds before you would ever need to touch those equities, which may be distressed. And also put yourself in a position to perhaps rotate into some cheaper stocks if you can afford to do that. So again, cash is our friend, especially for those who are getting very close to large long-term goals that they have, like retirement.
Certainly. And so of the different asset classes that you've been monitoring over the course of this week and how you've been watching investors kind of either reallocate or reposition and flow into some safe havens, or maybe they've looked at gold and perhaps they've been in gold long, or they're just new entrants. How are you kind of assessing not just the equity market, but other types of assets that investors could leverage to stabilize their portfolio during times of turmoil?
Sure. So again, not wanting to be too reactionary here, if you're kind of jetting out the door into those safe havens, or whether that's gold or fixed income, you want to be very careful with just how much you're becoming risk off here, especially trying to link that to your time horizon. At the very least, rebalancing your portfolio when you see equities come down. So if you're a 60-40 investor and you notice that you're gravitating towards 50-50, if your target is a little bit more risk on at that 60-40, it's a great time to rebalance and scoop up cheaper assets. Again, really coming down to tolerance for risk and time horizon. These are classic long-term investment strategies that will never change. They're evergreen. And if you're getting too cute or too sexy, that's really where you can start to make mistakes.
Douglas, thanks so much for taking the time here with us. Really appreciate it.
Thank you.
Looking for safety in a rocky market? Havens might be for you. A safe haven asset is an investment that's expected to either hold or gain value during periods of economic turbulence. Joining me now to discuss, we've got Mike McGlone, who is the Bloomberg Intelligence Senior Macro Strategist. Mike, you got to break down some safe havens for us, especially this week, and why they tend to hold value during volatility in the market.
Hey, Brad, we have to start with treasuries, and treasury T-bills are the safest assets on the planet. You want to extend a little duration. If we get some deflation, you go out to T-bonds. But of course, there's gold. Now, gold's somewhat of an alt safe haven store of value, and as we know today, it reached $3,000 an ounce, but for good reasons, partly because the stock market's starting to go down.
And so with that in mind, where are the most popular safe haven plays that we've seen really emerge over the course of volatility like this week?
Well, this week it's been gold, most notably, partly because there's a unique situation now where we've had a good almost 15 years of the U.S. stock market going up and the U.S. dollar, based on relative to the rest of the world, going up at the same time, i.e. they're together, the U.S. dollar and stock market. Now they're both going down together. Both of those are good things for gold. This is a question how much further they go. And as your previous person came on, it said you have to be nimble in this space, but I'm worried it's going to continue. So gold punched up around 3,000 today. I'm just afraid it's going to stay higher, even though it's pretty good resistance for now. But generally, safe haven number one is treasuries. Gold's part of that. It just also is a risk asset too. It does move around. It's just known to be basically zero correlation to the stock market.
Is what's held true with this new marker for gold and this new record for gold that we've seen struck this week? Does that hold true for the rest of the metals and other commodities when we see a safe haven kind of inflow like this?
No, definitely not. So gold is the only major commodity over time that typically goes up. The way I like to describe most commodities is most commodities go down because they went up. Look at crude oil. It's at $67 a barrel right now. It went down that much because it went up too much to the peak in 2022. That turns on the forces of elasticity of supply and demand and pushes it back lower. You've seen that with egg prices right now. They're going down because it shut off demand because prices went up. Gold is the only one that goes up over time and stays up, particularly for investors, because you can invest it and hold it on your body. It's easy to store. The most significant metal that's really rallying this year is copper. Copper's near an all-time high. It's reached near $5 a pound, but it's going up for basically the wrong reasons. It's worried about tariffs. The U.S. is a net importer of copper, so it's pumping up the price of copper in the U.S., but much more, actually the widest spread ever versus copper that trades in London. So I'm worried that copper, the metal known as a PhD in economics, it's kind of indicative of global economic growth, is more likely to go lower, but it's proven me wrong lately. It keeps pumping up higher. I'm just worried if the stock market continues to go down, gold will go up, and copper will have pressure to go lower.
And what does that hold for some of the other safe havens that are more stable? And you mentioned bonds, you mentioned how people will typically look at treasuries and look at the steady rate of growth if they're looking to kind of remove some risk from their portfolio.
Well, the number one way to remove risk from portfolios is to lighten up on risk assets. And the riskiest assets are cryptos. I like to point out, it looks like Bitcoin's peaked around 100,000. That's why gold's continue to go up. That's the number one reason. Keep it simple. Just sell some. I mean, hopefully not in the way down. The key thing I want to point out, the risk I think that Gold's pointing out is we have more significant risk towards normal deflation on the back of inflation. That's the rule of what happens historically when you get a lot of inflation. We did. Now we're starting to deflate a little bit, i.e. risk assets. You're seeing that in China. Severe deflationary forces, which tilts me over to the U.S. Treasury long bond. Right now, the U.S. 10-year note's at 4.3%. In China, it's 1.85%. A lot of the other countries in the world are much lower. So if the stock market keeps going down, that means pretty significant deflation. It's just deflating the inflation we had. It means the Fed will have to ease. I mean, some of the best performing assets might be U.S. Treasury long bonds, and they have a pretty significant discount to the rest of the world. That's also part of what's helping gold get a bit of a bid.
Mike, really valuable insights. Thanks so much for breaking this down for us.
Thank you.
In the event of an economic downturn, you may want to look for ways to have your money work for you. Catalyst co-host Madison Mills is here with some ways that you could earn passive income. Hey, Maddie.
Hey, Brad. Yeah, passive income. It's the wealth building strategy of the rich. A set it and forget it way to earn extra money from a source that requires little to no active effort. Sounds great, right? Let's run through a few passive income vehicles. First, you could put your money into a high yield savings account or a CD. A high yield savings account does allow you a little more flexibility. Your cash is liquid. It's sitting in the account. You can easily access and transfer it to your checking anytime you need the money, with most allowing you to withdraw as much as 5 times a month. But the interest rate can change periodically. Meantime, a CD offers a fixed rate, but your money has to remain in the account for set time period, 6 months, a year, even 5 years. You can find the top rates as of March 2025 for both of these vehicles on the Yahoo Finance website. Right now, the top high yield savings rate is 4.35% at Basque Bank, and the best CD rate also at Basque at 4.45%. Next up, dividend-paying stocks. Some companies pay their shareholders a dividend or a portion of their earnings at regular intervals. It could be monthly or quarterly, and it could be in the form of cash or shares. Billionaire investor Warren Buffett, big fan of dividend stocks. His top holdings include names like Apple, American Express, and Bank of America, which all pay dividends. And lastly, real estate is tied to a tried and true investment tactic for many wealthy Americans. One option for those who own property: you can rent out rooms to tenants, offer short-term rentals via Airbnb or another platform. And if you don't own a home, you can still invest in real estate through real estate investment trusts, otherwise known as REITs. A REIT is a company that owns and operates investment properties and sells shares to investors to generate capital that it can use to buy and maintain properties on its own. This lets investors earn income from real estate without having to manage properties themselves. Back to you, Brad.
Thanks so much, Maddie. Coming up, we'll bring you tax tips to help preserve your wealth and economic uncertainty amid it. Thanks so much. Let's get a check of the markets as we are 2 hours into today's trading session. The Dow Jones Industrial Average up 1.4%. The NASDAQ Composite up 2.25%. And the S&P 500, that's up 1.8%. Let's put this in some context for you with the move that we've seen over the course of, we'll go this week. We don't need to go back as far as 6 years. But this week, with some of the slippage and the correction territory that we saw entered into Thursday, a lot of you out there wondering, okay, what does this mean in terms of the move that we've seen over the past 5 days here? And so ultimately still net lower over this 5-day period by about 2.5% for the S&P 500. And then taking a look at the NASDAQ Composite as well, over that period, we're still down by about 2.8%. And for the Dow Jones Industrial Average, I'll click on over to that, down by about 3.25% here. Let's move this out to the month-to-date scale for us as well here. This will bring us into the 11-day move here. And so even with today's bounce, we still got a lot of work to do, obviously, because trying to climb out of correction territory, which, by the way, correction means we've moved 10% from the most recent highs. We still got quite a bit of work to do. However, we're doing a little bit of work on the session, and some of the areas that are doing the most work, take a look at the 11 S&P 500 sectors. Technology getting a big bump here on the day. That's up by about 2.7%. Some of the biggest names that are outperforming within. Let's take a look at the NASDAQ 100. You're seeing big gains to the tune of 4.6% for NVIDIA. You've got Palantir moving higher by about 8.5% on the day. Meta, Alphabet, Amazon, all of those contributing as well here today. Well, in the event of a market downturn, investors want to look for tax strategies to help preserve their wealth. Joining me now with some advice, Dan Geltrude, the founder and CEO of Geltrude & Company and author of the book, Dogs Taught Me Everything I Know About Business. Dan, good to see you. One strategy investors may have heard of is tax loss harvesting. Can you break down the benefits?
Sure. So if you have some investments out there that are not performing or you don't think are going to perform the way you had originally anticipated, now may be the time to sell that. You collect those losses to offset your capital gains. So that's what tax loss harvesting is about. Now, if you don't have enough losses to offset your capital gains, or I should say if you have more losses than capital gains, you get to carry that $3,000 first, $3,000 against ordinary income, and then you can carry that into the future to offset ordinary income. So it's all about managing your portfolio to see where you have losses, where you have gains, how you could offset them.
And so there's one other thing that you talk about as well, which is a wash sale. What exactly is a wash sale? Can you break that down?
So what people may be thinking, hey, now's a great time to sell a stock at a loss. I'll take that loss, offset my gains, and then I'll repurchase the stock. Not allowed. You have to look at a 30-day window before and after the sale, because that will negate the tax offset or the tax benefits. So the whole thing about a wash sale is to stop people from these quick sales and repurchases only for tax purposes.
What about Roth conversions? When does it make sense to convert assets?
Well, let's just back up for a second and talk about how a Roth works. Now, the whole thing about a Roth is it has after-tax dollars in it. It grows tax-free so that when you pull that money out, you are not paying any tax. So looking at what the rules are, when's the best time to use it? So it's really ideal when you know you are going to be in a higher tax bracket later on, so that you would get the benefit of taking that money out and not have to pay higher taxes. The same thing goes with if you're currently in a lower tax bracket. That's when you want to put those dollars in post-tax so that you get the long-term benefit of that.
And so with all this in mind, how can taxpayers perhaps maximize their potential deductions and credits during a downturn?
Well, I think the first thing that you have to look at is always to look at increasing those contributions into your IRA or your 401k, because that immediately will take down your taxable income. You also have to look at those tax credits that are out there, the earned income tax credit, the child tax credit. These are things that are out there that if you qualify, you absolutely want to take advantage of. Let's not forget, student loan interest, your HSA contributions, your medical expenses that exceed 7.5% of AGI, you get tax benefit from all these things. So there's a certain awareness that you need to have for what's available to give you the best legal outcome with your taxes.
So what are some of the new tax policies that could impact high net worth investors?
Well, here's the thing. We haven't had a lot of tax changes as of now. But the main thing is to look at where we're going to go with the Tax Cut and Jobs Act, because at the end of 2025, that's going to expire. If they can't come up with a tax deal in Congress, what's going to happen? You're going to have estate taxes going up, individual tax rates going up, loss of business deductions. There could be adjustments to capital gains tax rates. There's always that carried interest that's out there that people are always talking about getting rid of. That's for your hedge fund managers out there. And of course, corporate tax rates. So really what's happening here, Brad, is we have to look to see whether we're going to get new tax laws or what we have now expires, and then we're going to have some significant tax increases. So it really all depends on what the president and Congress will be able to do this year.
Certainly. Dan, thank you for taking the time here with us.
Thanks, Brad.
Coming up, everyone, how you can take inspiration from the ultra wealthy and find opportunity in volatility. That's next. During the recessions of 2001 and 2008, incomes fell for Americans across all wealth levels. But when it comes to recovering from economic downturns, the top 1%, oh yeah, you guessed it, they tend to bounce back faster. One reason, the stock market. Three figures who bet big in the financial markets: John Paulson, who's bet against subprime mortgages, earned his firm $15 billion. Jamie Dimon, the CEO and the head of JP Morgan Chase, purchased Bear Stearns and Washington Mutual in the depths of the crisis. But the investments paid off, bringing JPM stock from a 2009 low of $23 per share to roughly $230 a share today. And Warren Buffett, whose investments during the downturn netted him $10 billion. For more on finding opportunity in all types of market volatility, from this week's correction to a major downturn, I want to bring in Lisa Kirschenbauer, who is the Omega Wealth Management founding partner and senior advisor. Lisa, great to have you here with us. So how do we overcome fear in volatility like this to find opportunity?
Yeah, Brad, it's hard to get there right now. There's a lot going on. And I think the key is figuring out what you're really most concerned about, and then trying to mitigate that risk or whatever your concern is. It's not a one size fits all. It depends on where you are in your life cycle. And yeah, are you working? Is your job secure? Are you retired? Are you living off the portfolio? Once you can start to get a handle on that, I think it's a lot easier to shift to where are there opportunities? Last guest specifically was talking about tax loss harvesting. The wealthy know that's a strategy. You also mentioned Roth conversions, being able to convert your IRA at a lower value. What the wealthy are able to do is take advantage of opportunities. But you got to know what your risks are before you can move to what your opportunities are.
Earlier today, we had Alti Tiedemann CEO Michael Tiedemann, whose firm has $77 billion in assets under management, AUM, saying this about rebalancing client portfolios.
There's been substantial repricing in high quality fixed income as an asset class. So we have gone from 3 years ago being dramatically underweight that asset class to now more in balance than we have been certainly for the prior 10 years. And then we have a lot of diversifying assets and a lot of assets in private markets.
Lisa, I just want to get your reaction and what you make of that advice.
Yeah, absolutely. I think there is a rebalancing opportunity. The key is, what do you need your portfolio to be doing for you? How growth oriented do you really need to be? Doing some of that stress testing and planning. Planning is one of the things we can do to mitigate fear and risk right now. So yeah, I think it's a great opportunity. It's just hard for people to go against the grain. Right now, the fear is the action you want to take is to sell, and yet really what you want to be doing, if you can, is to actually lean into the opportunities.
So what are some strategies for looking at long-term wealth generation?
Yeah, I think what we've learned, there's a number of things that the wealthy know that they need to do. They don't go to cash, but they do think about having sufficient cash reserves, maybe shifting, to more cash and bonds on the money that you're living off of, not the entire portfolio. So what we're trying to avoid is what we call bad timing risk. That means you're selling the portfolio or parts of the portfolio when it's going down. So doing some tweaks on where you're pulling money from, having sufficient cash reserves, maximizing the returns on your cash, understanding where the risks are, not just in your portfolio, but overall. Are your insurance, do you have the right insurance to protect against wildfires and against legal ramifications, and then staying invested. I mean, that's really the key, is staying invested, but shifting your portfolio as needed to support maybe current cash needs or upcoming cash needs.
And so understanding that we don't have the same amount of assets or capital to throw around like a Jamie Dimon or like a Warren Buffett, but there are lessons we can take from past downturns, how the super wealthy have navigated that, and perhaps scale that to our own portfolios. What lessons can we take from some of those past downturns?
Yeah, absolutely. I mean, I think it is again, where you pull from in your portfolio, if you have to. If you're working, your job is secure, then you should be investing right now as the market is moving down. You're getting to buy low. That is, the wealth know how to do that, and they do that. And obviously, keeping sufficient cash reserves and trying to maximize the yield you're getting on that cash is important. Diversification is the key. We don't know where are the best market opportunities right now. Is it international? Is it US? Is it bonds? Is it stocks? So you've got to hedge your bets and have money in all the different areas in order to be able to mitigate market risk. There's all kinds of different market risks.
Lisa, thanks so much for joining us here.
Thanks, Brad. Take care.
Coming up, how to make your debt more manageable, even in periods of economic strife and challenge. That's next on Wealth. Americans' total credit card debt hit another record high at $1.21 trillion in the fourth quarter of 2024, according to the Federal Reserve Bank of New York. Nearly half of Americans carry a balance on their card month to month, and rates over 21% right now. In the face of economic uncertainty, the first thing that you want to do is get your personal finances in order, and that includes dealing with high interest debt that could bog you down when times are tough. Joining me now with some tips to lower rates on outstanding debt is our very own Carrie Hannon. Hey, Carrie.
Hey, Brad, good to be here. Yeah, this can be pretty frightening if you have these high interest credit card debts. So there are really 5 basic steps people can take. And the first thing, the easiest thing to do is call your lender and see if you can negotiate with them. If you have a history of timely payments and all of that is consistent, you have a chance of getting them to knock it down a bit. So that's your first line of attack here. The second thing is to shop for a 0 interest transfer credit card. What that means is you can roll over that 20% plus interest to a 0% rate, which can last anywhere to maybe 21 months. That gives you 0%, so that's some breathing room, and you can start getting this paid down without any interest accumulating. This is fantastic. You may pay a fee of 3 to 5% of the amount you transfer, or on that amount, but it's well worth it if it can give you that wiggle room and that breathing room. The third thing, if those 2 things aren't working out for you, is to look for a personal loan. You might be able to get a personal loan from a local bank or some such that will give you a rate of around 7%. So you can consolidate all that debt, have 7%, and these can have terms of maybe 7 years. So that's one avenue to look down as well. The fourth thing I would say is, okay, there you are, you've got to start paying these down. So I recommend doing what is called the avalanche method, which is you start with the highest interest credit card and work your way down. Just tackle the highest first and keep rolling down. The final thing, and this is sort of a last resort for many people, but it can really help if none of those other things are working, is look for a nonprofit credit counselor. And you can find those. The Justice Department has a list of ones that they have approved. They can do that negotiating for you with those lenders to help get a lower rate. But again, this is not the time to sit on your hands and not take control of this debt, because it will continue to mushroom.
Carrie, thank you so much for breaking this down for us. Really appreciate it. Let's do a final check of the markets here, taking a look at the major averages right now. The Dow Jones Industrial Average is up 1.5%. The S&P 500 holding on to gains of 1.9%, and the NASDAQ Composite, you're seeing that in the green by 2.3% at this point in time. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They will count you down to and through the market close. You do not want to miss it.